It's been a massive week for financial markets. Of course, not so long ago, everyone was just worried about who the next Fed chair was going to be. Well, on top of that, we've seen a tech-led sell-off following the latest release from Anthropic, as people were just trying to wonder which companies are going to see significant demand destruction and margin collapse when we see these AI tools taking things that should be worth a lot of money and making them very cheap. Well, that's disinflationary, but it's also destructive for businesses, and we are seeing significant downside around that. Well, in the week ahead, we of course shouldn't have the job support, but we do, because we have the US shutdown, which now has been resolved. That meant that the NFPs and the unemployment rate didn't get released on the Friday, and said we get it this coming week. So that provides one centerpiece for a week that by and large will continue to focus around the likes of precious metals volatility, the tech space, alongside data coming out of the US and the UK in particular, and the ongoing earnings season. Let's jump onto the economic calendar and see exactly what we've got in store. Monday, starting off with a focus on Australia with a consumer confidence figure. That Australian theme continues into Tuesday with business confidence, retail sales out of the US. Wednesday, inflation data out of China. And then we see that job support coming in on Wednesday, with non-farm payrolls expected to decline down to 40K from 50K. So ongoing weakness with higher unemployment. Then Thursday, we've got a raft of UK data points. This comes off the back of the latest Bank of England rate decision, where we saw them vote 5-4 in favour of a pause, a lot closer than many had anticipated. So the possibility of some strength for the FTSE, perhaps some weakness for the pound, perhaps. Let's look at how the data shakes out. And then on Friday, we've got the inflation figures coming out of the US with CPI and core CPI, of course, set against the backdrop of seemingly a relatively hawkish new Fed chair, if Walsh is to be approved in that position. So let's look at the US first and foremost. We can see the sort of wider spectrum of events for the week. The ADP weekly payrolls figure on Tuesday. Again, retail sales, that job support, the initial jobless claims, the inflation figures. Of course, the week just gone was supposed to see the job support. That got pushed because of the US shutdown. What we did see was concerning figures out of the Challenger job cuts figure, the highest number since 2009, and the highest January figure since 2009. And then job openings from JOLTS dropping to the lowest level since 2020. So we are seeing some concern in the jobs market already. Will we see that reiterated once again? Well, markets are expecting exactly that, 4.5% up from 4.4 in unemployment, and further weakness in terms of the non-farm payrolls figures. Again, like I said, when we've got Kevin Walsh, who historically has been very hesitant when it comes to easing monetary policy, generally because he's always fearful of a rise in inflation, that really heightens the sensitivity around any inflation data that comes out of the US. On this occasion, we've got the CPI figures. Markets are expecting it to remain under control once again, with monthly figures of 0.2 and 0.1. I think I'll probably try and make a video specifically for this release, but nonetheless, we'll take a little look at exactly how things could shape up. But essentially, a continuation of that downward trend in terms of inflation expected, 2.5 on the core, 2.4 down from 2.7 on the headline. So significant disinflation. And that could really play into a theme around perhaps the fears of Kevin Walsh being this big hawk being unfounded. In part, you've got to think, why would Trump, who's spent all of his time trying to push out Powell, now he's got the DOJ trying to go after Powell, why would he spend all his time trying to get more rate cuts from from someone that has been cutting rates, only to replace him with someone that doesn't cut rates? It makes no sense. Now, we know that Walsh is a close family friend of Donald Trump's family, so therefore you've got to think that he's in his ear in a big way. So you could think that Walsh, the fears that we're seeing for markets, highlights the perceived independence and the perceived free thinking of a Fed chair that ultimately will do the bidding of the president. So that could mean that he has greater backing from the Fed board if they've known him in the past to be very hesitant. And on this occasion, he's coming forth with relatively dovish thoughts when it comes to interest rates. From the perspective of the jobs data, like ultimately, we generally see weakness for the US dollar when we see weakness in terms of the jobs data. That's what we're seeing here. So the weaker the non-farm payrolls figures go, generally, the weaker we see the US dollar, because the Federal Reserve need to step in and take a more dovish approach. As a result, that means that if we see further downside in terms of payrolls, further depressed figures, it points towards a possibility of weakness for the US dollar. Now, of course, we have seen the ADP payrolls figure, and that came in weak once again. You can see at the top. And so that really points towards more of the same. I know that people are sort of hesitant to utilize the ADP figures, but quite frankly, when you're seeing so many shutdowns, you start to rely a lot more heavily on these private numbers. But yeah, the question mark here is whether we're going to see a rolling over of the US dollar in particular, as markets kind of wake up to the idea that actually the pathway for rates could be more significantly towards the downside than has been priced more recently. Now, off the back of the jolts and the challenger jobs figures yesterday, as I speak here on Friday, we have seen a repricing towards additional rate cuts. This is December, so this is essentially by the end of the year, where are we going to stand? And now you're seeing additional bets in favor of 2 rate cuts or 3 rate cuts, whereas all along it's been a case of we might get 1 rate cut if we're lucky for this year. That's been the case over the course of the past month. That's starting to change, that narrative. Will we see a turnaround in terms of the US dollar? Well, first and foremost, let's look in terms of the dollar index as a whole, right? So ever since we saw that news around Warsh a week ago, we've seen the rebound taking hold for the dollar index. Now, from a wider context, we can see it's set within a bearish trend. And you can see that we do see periods where we see that long lower shadow. Let's just zoom in a little bit here. The long lower shadow here, providing the basis for a period of gains, and then ultimately it's been sold off. So are we set for a protracted period of upside before we actually realize the Fed are willing to step in a meaningful manner? Do we see this come to an end now? Well, let's look in terms of shorter time frames. Here's the daily time frame. So I think, you know, where we're going to be drawing our fibs from, if we're looking at this as a retracement, would likely be this 99.5 level. So let's look here. So we've touched that 61.8 Fibonacci level, which is at 97, essentially 98, almost perfectly, right? So this provides the basis for a potential rolling over of the US dollar index and the US dollar, particularly if we see further weakness in terms of the jobs data Wednesday, and further weakness in terms of the inflation data Friday. So this week ahead does provide the basis for a potential turnaround in the US dollar. Of course, we haven't heard from Warsh at the moment. Everyone's just going crazy and trying to read his previous comments. But I think there's a good chance that people wake up to the idea that actually he has said that the disinflation from AI should provide the basis for a more dramatic move lower for interest rates. So I think rates are going to go significantly lower than people are currently expecting. And that repricing provides the basis for a potential move lower for the US dollar. I wanted to jump onto the price of gold because, of course, that sell-off that we saw in gold, there you go, on Friday, Thursday top, Friday, the big sell-off. Well, you look back at the price action in the US dollar, and essentially Friday was the big move higher. So around that Warsh news that we saw a big rise in terms of the US dollar and a big sell-off in terms of the price of gold. And so whilst at the moment everyone's sort of wondering exactly how long the sell-off's going to happen, silver seems to be getting manipulated to a much higher degree. You're seeing major short sellers over in China, you know, on a day where you see silver down 20%, gold's down 2%. So yeah, it's going for the ride. But ultimately, you're really seeing the value of the relative stability of gold at the moment compared to silver. Everyone's sort of jumping on that silver bandwagon. Well, it's looking a pretty dicey market at the moment. But nonetheless, if we do see the possibility of a turnaround in the US dollar, so let's just overlay this, put it on a different scale, and then we'll invert it. So we're seeing correlation between the two. There you go. So that means that if we see weakness in terms of the US dollar from here, it provides the basis for a bottom here for gold. If we see a continuation of the strengthening of the US dollar, it points towards another leg lower for gold. So certainly that is why these releases for the week ahead in terms of potential weakness for the jobs market reiterating the need to do more, and potential weakness in terms of inflation, reiterating that inflation isn't a problem. Both of those can feed into a narrative that could see the US dollar rolling over and the price of gold turning upwards in a meaningful manner. Once again, we're seeing it at the moment. You can see this 61.8 Fibonacci at the moment has been tagged. And then on the short-term time frame, you can see that that trend lower looks like it's potentially about to break with a move up through 49.06. So potentially the bulls could come back into play for gold this week ahead as well, if it plays out how markets are expecting, according to the economic calendar. Next up, let's look at the UK. So the UK, of course, we've just come off the back of a Bank of England interest rate decision. And in that decision, they opted to keep rates steady. So the headline is relatively boring. However, when you look into it, it's a really interesting one, because if you've been watching these videos that I've been making for a very long time, I've been essentially showing you that the base effects means that we're going to see a collapse in UK inflation, and that soon enough, by April, May time, we're going to go from, near enough 3% inflation to near enough 2% inflation. And soon enough, we could see inflation below 2%. And so that collapse that was due to take place, or is due to take place over the course of like a 2-month, 3-month period, points towards a potential repricing in terms of expectations for the Bank of England. And that started because we've seen the Bank of England essentially now saying, we think inflation is going to target by April. And we think that, ultimately soon enough, we're going to need to cut. And that's highlighted by the fact that instead of 7-2 in terms of the votes that markets have been anticipating, it came in at 5-4. So 1 vote away from having seen a rate cut in this week just gone. That means that as we move forward, the sensitivity is a lot closer in terms of economic data, because all it takes is one sort of rolling over in terms of the data, and people at the Bank of England are going to think, well, we already know that inflation is pretty much defeated, and now we're seeing weakness in terms of the UK economy, so it's time to act. So with that context, we've got GDP data coming out on Thursday, a whole raft of data points coming out. In fact, manufacturing production, industrial production, construction orders, you name it, we're going to get a whole host of data from the UK. And then against that backdrop, we'll be looking at the likes of the FTSE 100, the likes of the pound. Of course, euro sterling has been something I've been talking about for like a year now, and talking about the potential resurgence of it. And that's what's playing out at the moment. I should probably do my victory lap now, but instead I want to talk about the FTSE 100, because I think that's also got an interesting narrative at the moment. This is the sort of backdrop to UK GDP. We actually saw a sharp pop last time around of 0.3% for the monthly metric. Now, of course, that's sort of counterbalancing the weakness we'd seen in the previous months. And, we had seen a sort of shutdown in the automotive sector that had been resolved, and that's part of why we saw that rebound in terms of that latest monthly figure. But certainly, if we do see some weakness in terms of the economic data, that could point us in the direction of further easing from the Bank of England. If you look at expectations for the Bank of England, March, essentially a coin toss, and then we start to get into the realms of markets feeling pretty confident that we're going to see a move down to 3.5, and then maybe we see another move from there. But certainly as the data adjusts, I think it's much more likely that we will see a move from there towards lower rates. It's just not being priced in at the moment, because we haven't seen inflation drop in the way that I would expect to happen. Let's jump on to the price, or the chart for the FTSE 100. Now, this is particularly interesting, because if we're looking at the FTSE, let's see, UK 100, let's grab any of these, divided by any of them. The Nasdaq is the most prominent at the moment. So we're seeing this sharp resurgence or surge for the FTSE against US markets, particularly US tech stocks. And the sell-off that's happened over the course of the past week isn't just the Mag 7 names. The Mag 7 names got sold off heavily at the back end of last year around this narrative that they've spent too much money. That's still happening, and the valuations are too high, and they're not going to get their money back. And so those elevated valuations, once it comes into question, you see a bit of a sell-off, right? That happened at the back end of last year. This time around, we're now starting to see some of the things that are coming out of AI companies, most notably Anthropic this time around, undermining the valuations and the profit expectations of companies throughout different sectors. The one that people are really grabbing onto at the moment is the sort of SaaS services as software as a service, sorry, but essentially software companies, services companies, and legal companies, data companies, all of these have gone from charging sky high prices to potentially being replaced with a tool that costs next to nothing on the AI space. So the difficulty of this is that essentially you're seeing the losers, but we're not seeing the winners, because the winners on this one, the winner on this occasion is Anthropic. It is a private company. And so that's a difficult one, because there's always been this perception that like the tech companies are going to gain, but other companies within the market will lose, and net maybe the tech companies keep the market afloat. But when you're seeing lots of losers and you're not necessarily seeing many winners, it's a bit of a concern. But in terms of the narrative it provides the basis for people to think that now is the time to recalibrate their portfolios towards essentially businesses that are geared towards the real economy. Now, the thought process of Kevin Walsh over in the US appears to be that he wants to shrink the balance sheet, but he wants to enhance the liquidity within banks for them to essentially inject money into the real economy through businesses, rather than injecting money into the banking system for them to make huge amounts of money alone. And so that points towards a desire to really pump up the real economy. What is the FTSE 100? It's not a tech-led market, and that's why in the past people have not necessarily been too keen on it, because it appears to be very boring compared to the US indices. Certainly, when you can see a company like, I don't know, Microsoft or Apple or you name it, right, Nvidia, seeing rampant growth, then some of these boring companies in the FTSE 100 don't look great. So you can see that in the ratio between the Nasdaq and the FTSE 100. It's a one-way bet. Right now, at the moment, we're seeing this period of strength for the FTSE against those US tech companies, as people are starting to realize maybe there's too much risk in those tech names, and maybe we need to get aligned with the real things in the world. The real things include things like commodities, and the FTSE 100 is heavily geared towards commodities. So as you can see, at a time where we're seeing US markets faring pretty poorly, let's get the Nasdaq on here, but this time we'll just do it in its own right. So you can see here the Nasdaq essentially seeing that sharp pullback, while we're seeing strength for the FTSE 100. So it starts to look like a bit of a haven when it comes to the equity markets. So further upside does seem likely. These pullbacks are likely opportunities rather than something that points towards the top for the FTSE. And so, we've come into the 76.4. We're starting to strengthen. We're starting to move into a period where UK inflation signals the possibility of additional rate cuts and easing from the central bank. All of this really feeds into a narrative that the UK market is a pretty good place to be at the moment. So unless we break the 101.22, I think the FTSE 100 is a really interesting market to be following and trading right now. And sticking with that theme around the real economy, I don't know how real you want to call McDonald's, because I've tasted their chips and they taste like cardboard. But nonetheless, they have their earnings coming out this week. And at a time where people are worrying about earnings for tech companies that are going to get replaced by AI, essentially, the services, I don't think AI will do anything but profit companies like McDonald's. They might have a robot serving you in the future, so it brings down their costs. But I don't think it's going to suddenly take over their business. And therefore, people, I think, are going to look back to these companies, the kind of companies that you often see the likes of Warren Buffett investing in, Coca-Cola, McDonald's. Your basic standard companies, I think, are going to be the ones that people go back to. Essentially, the outperformance of the Dow, this sort of old school way of thinking, materials, physical things, physical goods. That's what I think are going to do well. In terms of the sort of breakdown from a sector by sector basis, this really highlights what's been strong and what hasn't of late. Let's get the full screen on that. And so you can see consumer staples at the top of the pack of late. This is over the course of the past week. I'm going to have to full screen it myself so I can see exactly what's what. Okay, so we've got information technology right at the bottom. So tech being hit hard. We've interestingly got consumer discretionary, so sort of high luxury goods, not necessarily doing very well. So the perception of sort of economic weakness is still there. But certainly when you're talking about things that are perceived to be staples in people's lives, I would say that things like a McDonald's and Coca-Cola aren't necessarily a massive luxury good akin to your Hermes handbags or your Burberry jackets and the like. Energy also doing pretty well of late, but then after that, you've got the likes of the industrials, the materials. So again, like I said, this idea that there's going to be a continued build out, this idea that commodities are going to be doing well in a world where the US and China are trying to stockpile goods, that points towards another area of strength. But like I said, when it comes to those sort of basic goods that people just continue to demand, it really signals that Coca-Cola and McDonald's are going to be two interesting areas to watch out for in the week ahead. Here is the, no, that's my head. Here is the breakdown for Coca-Cola, and I've put it on an annual basis just to show you that essentially this is a company that's expected to just continue to grow. None of the hype that you get with some of those AI names that then blow up at the end of it, or at least you get fear around them blowing up. Just continued growth year on year for revenues and earnings, the same kind of thing for McDonald's, and therefore they're good charts to be watching out for in terms of potential trending markets. So let's jump off of that and into the charts once again. There we go. So this is the chart from McDonald's, and we can see here from a long-term perspective, it has been a strong performer. More recently, you do see these pullbacks coming into play, but arguably from a sort of fib perspective, you're seeing lovely deep retracements, lovely 76.4 fibs all the way up. That one slap bang on it. Then there's another one here and another one here. So in actual fact, every time you see a pullback into the 76.4, it's just provided great opportunities in the past. On this occasion, well, you can see that we've actually broken up. Let me try and get rid of some of these different fibs. That's so fun to draw on. Okay, there we go. There's the weekly time frame. So very clear upward trending market at a time where we're sort of seeing this kind of company come into fashion. Let me just try and get that second one on there. Okay. Yeah. So we've got this resistance level we're trying to break through at the moment. We've seen a little bit of a pullback since attempting to break up through that. So certainly, as with sort of historic resistance levels, sometimes you've got to make sure that we actually get that close above that level to reiterate the point that it's broken and that you're going to push on from there. So we're starting to sort of weaken a bit here, but the trend is very clearly in play here. If we see a deep pullback, then again, that's just a case of watching for that wider fib retracement. But for me, I think this looks to be a good stock going forward as people start to look for the boring amidst stories of AI taking over the world. Well, I don't think it's going to take over for McDonald's. I don't think it's going to take over for Coca-Cola. There's the monthly time frame for Coca-Cola, big breakout that we're seeing over the course of the past couple of weeks. And so this looks like a really interesting stock to be trading. Let's try and get into some sort of time frame where you can see a trend. There you go. It's the hourly time frame. So we're seeing a sort of gradual move higher, but this is looking like an absolute ripper of a stock at the moment. We've seen that breakout through resistance. And so, yeah, I think this is, again, another one that we've got to try and follow, see how the earnings come out. But this is rather than Coca-Cola suddenly having this whole new story about why it's going to do incredibly well. I think this is more a story of people trying to get out of things that they perceive to be risky and into things that they perceive to be relatively safe. And Coca-Cola and McDonald's fall into that bracket. So really interesting stories playing out within financial markets at the moment. And who knows, when that's going to come to an end. I know many people are talking about this as a major opportunity to be able to buy into some of these oversold tech stocks. That might be the case, but maybe in a few months' time, you're back in the same position and seeing another freak out. I think gradually over time, you're going to have to see multiples decline for some of these elevated valuations that have been attached to companies where we don't necessarily know what the future holds for them in the world of AI. And that's why everyone wants physical things. It's going to be the year of consumer discretionary, the year of the burger, the year of the can of Coke, and the year of the, in my mind, metals and minerals, as we see the likes of the US and China battling out over the world's resources. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name's Josh Mahony, Chief Market Analyst at Scope Markets. Thank you.